Good evening, everyone. On behalf of the Hyderabad Chartered Accountant Society, I extend a warm welcome to all our members and professional colleagues to today's session on foreign income and assets reporting in ITR. Recently, there are communications from IT department on disclosure of foreign assets and income, which is an important compliance requirement under taxation laws. With increasing globalization and cross-border financial transactions, transparency in reporting overseas assets has become essential to prevent tax evasion and ensure legal compliance under IT Act and Black Money Act. On this note, I would like to introduce our presenter, Mr. CAP Yashodhan sir, a practicing chartered accountant with 11 years of professional experience. He has also earned additional professional qualifications such as Diploma in International Taxation, DISA, and Certificate course in UAE Corporate Tax, which enhance his specialization in both Indian and international taxation along with compliances. With his expertise, knowledge, and valuable practical insights, we are privileged to have him share his expertise and guide us through this significant and relevant topic today. Without further delay, I invite CA Yashodhan sir to take over the session. Over to you, sir.
Thank you, Shamita. Thank you, HCAS committee for giving me this opportunity to present some thoughts on the foreign assets and uh, disclosure requirements under Income Tax Act and its nuances. So let's begin this a wonderful learning opportunity. So in recent times, if we see, there are a lot of communications from the department where there are certain foreign incomes or assets that are missing reporting in the income tax returns. So a lot of people in the month of December or so approached the chartered accountant saying that why we are getting this type of messages, whether we have missed out anything in reporting in the ITR, or really is it a genuine notice or any sort of fake messages from fraudsters. So a lot of confusion was there in the month of November and December months. So we took up this small topic to address whether it is a genuine messages or anything we need to ignore on this aspect. So we are presenting this topic. So if we get into the details, so we are going to cover these aspects in our 1.5 hour presentation. And so we are going to cover some key definition, what is foreign asset, what is foreign income, and how we need to disclose in the income tax return, and what are the regulatory scrutiny on the foreign assets concerned, and what are the common overlooked items while reporting in the income tax returns, what is the DTAA framework, if there is a foreign income, we can claim some foreign tax credit, what is the DTA framework, and some practical case studies, and whatever the latest budget to scheme announced proposed by the government. So what are the intricacies in relation to the BMA Act we are going to discuss. So if we come to the definition part, the foreign asset definition is not clearly defined under any law, but the scope of incomes and all are the topic of discussions is covered in multiple laws. So Income Tax Act, PMLA, and then FEMA Act, Black Money Act. So if you see foreign asset as a general meaning, it is an asset located outside India in which a resident Indian or a person from under the definition of income tax resident, if he is having any ownership or beneficial interest or financial interest in the asset outside India. So the exact meaning is slightly different in each law, but the core principle is same, that if it is outside India, if someone is holding the control or ownership over it, they have to disclose in their income tax return. So from Income Tax Act 1961 and 2025, the exact definition is not available under the given laws. But if we know that there is certain asset, there is certain income, how to tax that, what is the scope of total income, and there are some deemed provisions under which those incomes to be treated as to be reportable under Income Tax Act, and there are certain items where we have to disclose in foreign asset schedule under the respective ITRs. So the simple meaning is assets located outside India such as bank statements, investments, and any movable property, pension, gold, vehicles, or any artwork or any vehicles. So like that, we need to bifurcate and then disclose while reporting the income tax forms. So the reporting is irrespective of the size, irrespective of its activity, we have to disclose the same in the income tax forms. And then if we go to the next law where the foreign asset definition is concerned, under PMLA also there is no specific definition, but if it is relating to any proceeds of crime under PMLA law, and the source is from out within India or outside India, then it may cover like foreign asset definition under PMLA law. And in the case of FEMA generally speaks about the foreign exchange from a regulatory and compliance perspective. So under FEMA also the definition is not very clear, but it mentions that it includes an asset or property held outside India by a person resident in India. And if you go to the next part, so the first four parts are relating to the normal general understanding. And if we come to the next part, that is Black Money Act, if you go to the Black Money Act, the exact foreign asset or income is not defined, but interestingly, it is defined what is the undisclosed foreign income and what is the undisclosed foreign assets. So the definition or the interpretation starts from undisclosed foreign income or undisclosed foreign assets, which means if something is undisclosed, how to treat that under Black Money Act, how to uh, assess and how to take it forward by the department, they have covered under this Black Money Act. So this Black Money Act has been introduced in 2015 Finance Act and came into effect from 2016 1st April. So, so if you get into the exact definition, undisclosed foreign income and asset means an undisclosed income of an assessee from a source located outside India and value of an undisclosed asset located outside India. This is a core principle under the Black Money Act. So the scope of working around is covered under Section 4 and the methodology of computation is covered under Section 5. If something is covered under the definition of foreign income or asset, how that has to be defined or interpreted and how that has to be computed, what amount or how it should be calculated is covered under the Section 5. So if you get into the deeper meaning or how this act will be applicable on this undisclosed assets, undisclosed foreign assets, and undisclosed foreign incomes. Section 3 is a charging section which talks about if an item is covered under undisclosed foreign income and undisclosed foreign asset, it has to be taxed at 30%. So the Black Money Act, whatever it is not anything to do from the assessee side. If the department wanted to start its proceedings under Black Money Act, if they identified any foreign income, if they identified any foreign assets during their assessment, they will levy a rate, a 30% rate of tax on the undisclosed values. So the interesting part is it is not just about income which is undisclosed. It is undisclosed asset also. Example is someone holding any immovable property in out of India. They might be holding a commercial property or any residential property or shares or any pension accounts or any bank accounts. On the undisclosed part of foreign asset, they have to pay 30% tax. It is not on the income, it is on the assets. That is the most critical part of this Black Money Act. So if we go to the next part of the explanation, so the section 4 covers the undisclosed foreign income not reported in return or income where no return is filed. For example, somebody is having foreign income, but they have not filed income tax return at all. Or somebody had filed, but they have not included the particulars of foreign assets in their income tax return. So for both the cases, this Black Money Act provisions will be applicable, and whatever the consequences or proceedings under Black Money Act, those will take effect. And from standpoint of allowance of any expenditure, set off of losses, basic exemption limit. So nothing is allowed. For example, assessing officer has got some information either from the Income Tax Act or from the banks or from any regulatory authority. They simply calculate what is the total of undisclosed asset, what is the total of undisclosed income, and then simply calculate 30% tax on that. And then after calculation of taxes, if we calculate, the assessing officer got information and they have computed the taxes. There are certain penalty provisions applicable under the Black Money Act. On the tax computed under sections 41 of the Black Money Act, 3 times of the tax amount will be levied as a penalty. So assume if somebody got 1 crore value of undisclosed foreign income and asset, 30 lakhs anyway you are going to pay as a tax. 3 times of that, 90 lakhs, means more than the value of the foreign asset. They have to pay as a proceedings or penalties under the Black Money Act. So which is more than the foreign asset value. So while disclosure, while computation, either the assessee or even the consultant who is working around the income tax return, they have to take sufficient precautions to capture the details properly and compute the details properly and disclose the details properly in the income tax return. So this is the most stressing section under the Black Money Act, 3 times of the tax amount as a penalty. So there are additional 2 general penalties where it is not disclosed. See, first one is the tax part, and tax into 3 times is like how we have in Income Tax Act under reporting, misreporting. This is that part. And if these 42 and 43 sections, if you look into where foreign asset is there, we have not filed a return. Where foreign asset is there, we have filed return but not disclosed. So in every case, there will be a 10 lakh rupees as a penalty. So which means if any notice comes under Black Money Act and the assessment happened, and then the values have been arrived on the tax amount and then penalties amount, it will be always more than the foreign asset value. So we have to be double sure while calculating or taking details from the clients while compiling the details. And the next part is about the prosecution. Even the prosecution is also very critical and it is very serious under the Black Money Act. So the imprisonment starts from 6 months to 7 years. If you are failing to file the return, if you have a foreign income or assets, and then if you are not disclosing correct details, you have filed return but not disclosing correct foreign asset details, then also the prosecution is similar. And if it is an intentional evasion, like with an intent to evade taxes, if something is done, the imprisonment or the whatever prosecution is much rigorous when compared to the other 2 sections. So with this background, so we'll move on to the next topic, that there is some example on the penalty and proceedings. So there was an amendment in 2024. Earlier, either penalty or prosecution used to be different. If to trigger a penalty, the minimum foreign asset value should be 20 lakhs. Now, earlier the prosecution was irrespective of the value, prosecution may happen. But after the amendment to 2024, prosecution also they have limited the foreign assets. If it is not exceeding 20 lakhs, there cannot be any prosecution. So after crossing 20 lakhs, the tax will impact, the penalty will be there, and the prosecution also will be there. So this is a key amendment. But if we clearly observe this 20 lakhs limit, whatever it is, only for the movable asset. If there is an immovable property, it starts from the 1 rupee. It starts from, like, even I would say if you have some title in the other country, the penalty and prosecution will start. That is a more stringent position. So nowadays, many people are holding properties out of India and they are not disclosing the properties out of India in income tax return. If it is being identified by the department, either through exchange of information or any other sources, so then the prosecution and penalties are much higher. And then It's another small illustration on the same. So consider a person who owns the following assets and in overseas value of the immovable property is 12 lakhs. So if the value of the immovable property is 12 lakhs, whether the proceedings under the Black Money Act applicable? Yes, they are applicable, and because the value starts from the even 1 rupee under the immovable property definition. And then in the case of movable assets, if the value is not crossing 20 lakhs, it is only 15 lakhs in the given case. So then the black money provisions will not be applicable. And then how the assessment happens in the case of Black Money Act. So if we take under the regular provisions, there are certain time limits, there are certain what do you call concealed income limits, and then there are certain relaxation, exceptions, exemptions. So under Black Money Act, there are no much available relaxations. If some information is got by the officers, either through banks or through income tax department might share data with black money assessing officers. So then they can issue notice. It is not like it is relating to particular year, particular assessment, nothing. Somebody got an information today, they will evaluate. If they feel that this is an undisclosed foreign asset or income, simply they can issue a notice. So, and assessee has to respond to those notices by compiling the details and then giving explanations. And then AO, after scrutinizing them, he will pass the relevant orders. And then what are the time limits? So once a notice is issued, the assessment should complete within 2 months from the end of the financial year in which the notice is received. So the 2 years condition is there where the assessing officer will ask questions, assessee will give his responses, and then after all proceedings are completed, then they will pass an order. In these 2 years, if there is any stay order by the court or any reference to valuation authority, valuation officer, so those timelines have to be excluded. And after once assessment is completed, if there are any errors in the order, still the AO can rectify those errors or mistakes. This is similar to the Income Tax Act, where if there is any mistake apparent from record, we can rectify within 4 years. And the notice of demand will be issued. And according to the notice of demand, the payment of demand should be completed. So within 30 days, the payment should be completed per as our regular income tax rules only. And if there is no payment, then the recovery proceedings will start from the department side. So while computing the taxes and these payments, a 234 ABC interest is also applicable along with penalties. And if the assessee is not satisfied with the order, they can file an appeal with the Commissioner Appeals within 30 days with Form 2 and some 10,000 fees. And this is a manual process. As of now, the manual process is going on in the black money proceedings. And if CAT appeal order is also not satisfactory to the assessee, still they can file an appeal with the tribunal within 60 days. This is also similar to the regular income tax proceedings. And there is a Form 3 and 25,000 fee will be there to proceed with the appeal framework. So till this part, we have discussed on the definition under Black Money Act, what is foreign asset, what is foreign income. If we don't disclose, what happens, and what are the penalties, prosecutions. So some small examples. So now let us see who has to disclose this exactly, who is required to disclose these foreign incomes and foreign assets. So the obligation is on the resident and ordinary resident. This is specifically given under the instructions of income tax filing, where all RORs, if they have any income out of India, if they have any asset or any source out of India, they have to disclose these details. And in the case of RNORs, they have to disclose either RNOR or NRA, they have to disclose only the income which is accrued or receivable from India, because they are not liable for reporting foreign details in India. So because once they are part of other country, they need not disclose anything here. But if anything is generated or linked with sources in India, they have to disclose in their income tax return. And in the case of FA, foreign assets, the RNOR and NRA need not be required to disclose. And where is this foreign income needs to be disclosed? So what if the individual is holding a residency? Just somebody has posted a question. What if the individual is holding a residency of the country wherever the asset is there? So it depends on the residential status, sir. See, whatever his residency of the country, ultimately we have to calculate the residential status as per the provisions of the Income Tax Act, like 182 days, 60 days, last 4 years, 365 days, and again after that you have to calculate on the ROR, RNOR. Depending on that, you need to decide on the disclosure requirement. So if we go on to the next point on the foreign income disclosure, normal income schedules, first we need to disclose, like how we disclose under salary, house property, capital gains, other sources. First, we have to maintain proper workings along with domestic income. The assessee has any foreign income. If he has a foreign income, under each head of income, we need to maintain the proper workings. First, we need to disclose under the respective schedules, and then after that, we need to disclose in the specific schedules. So for specific schedules, let us get into the next slides. And here, while disclosing also, it should be on a gross basis. It should not be on a for net basis, because in some cases there will be foreign tax credit. So some people might think that after tax credit or after taxes, so we need to report the incomes here. So we have to disclose at a gross level, and then we have to calculate the foreign tax credits that we'll cover in the next slides. So under normal heads, once it is disclosed, there are some specific schedules called FSI. FSI means a foreign source income. So in foreign source income schedule, we have to report each country wise and each source wise reporting. So that looks like country code, country name, nature of income, gross income earned, foreign taxes paid, income offered to tax in India. So certain columns are there in that schedule. We need to disclose under foreign source income schedule. And a sample format we have covered here where FSI looks like. So many ITRs except ITR 1 and 4, all other ITRs have this sheets, FSI schedule, and then TR, that is tax relief schedule, and then FA, foreign asset schedule. So these three sheets will be available in all other long form audit forms. If you take 1 and 4, these are short 2-3 pages or 3-4 pages max. But if we get into 2, 3, and then 5, 6, all forms, you will find like 70-80 pages of the ITR form. So these are the three main sheets applicable for disclosure of foreign assets and foreign income. And the next part is Schedule TR. This is relating to the tax credits. If some taxes are already paid in out of India, those taxes we can club. I mean, those incomes once we are clubbing in Indian income tax computation, because in the case of ROR, the global income is taxable. So while consolidating income, we have to cross check or compare the foreign taxes paid, and under income tax, under Indian Income Tax Act, whatever income tax is payable with respect to foreign income and foreign taxes paid outside India, whichever is lower is allowed as a relief. So this particular sheet talks about that. You have to capture these details along with FSI and then cross-reference with FSI along with Form 67. This is an additional form where to get a tax relief, we need to mandatorily file this Form 67 along with Form 67 and tax relief sheet and FSI. We coordinate between these three details and then fill the respective schedules. And this is the sample TR form where we mention country code and then taxpayer identification number of that country where taxes paid outside India and tax relief available under FSI sheets where we will do computation and then tax relief claimed under the section, specifically under what section we are claiming. So this is the sample format. This is an important schedule to be filled along with FSI. And this is the sample form 67 form where we have to file to claim the foreign tax credit. And some cases it may so happen that somebody fill the TR sheet and forget to uh, file the form 67. So nowadays the assessing officer is while processing the form itself, the CPC is not taking the foreign tax credit if you don't file the form 67. So ensure that wherever foreign income and tax credit is there, ensure to fill this form to claim the tax credit. And this form has to be filed before filing the ITR due date. Other aspect is in respect of foreign income, we have covered FSI and TR sheet. The most important and the huge data where we need to collate, discuss, obtain information. This is the most important schedule if we talk our entire presentation or entire training on this topic, foreign assets. So in the case of ROR, it is mandatorily required to be disclosed all the foreign assets, even though income is not there, even though income is exempted, holding a dormant accounts, dormant shares or anything. If you hold certain asset, you need to disclose. Okay, covers foreign accounts, shares, properties, trusts. Because if you don't disclose, we have already discussed the effects of the Black Money Act. If you don't disclose, even 1 rupee immovable property exceeding 20 lakh, any other asset, you will be covered under the penalties and we will be covered under the lens of the Black Money Act. Okay, and then next. So what are the categories of foreign assets we are supposed to disclose? So let us discuss each category wise. So first, the category is the foreign depository accounts. So depository accounts where somebody is holding, maintaining with financial institution for holding and trading or safekeeping of his securities and financial assets. And then the next category is custodial account. Where somebody is holding with a foreign bank or a custodian for holding and safeguarding of the financial assets on behalf of the investor or sometimes even trust nominee. So they will hold shares on behalf of us. That also we need to disclose. So depository account, custodial account, the key difference is in the case of depository account, you will be able to trade on your own. You will be able to do transactions on your own. In the case of custodial account, you're just able to hold the assets, but regular access available. So there are certain FAQs on these two topics. So just ask my team to just start the poll. The question is, you buy and sell US shares yourself, whether it is whether it is a custodial account or a deposit account. So whoever is participating, you'll be able to see the screen here giving the answers. Everybody is mentioning it is a depository account. Yes, it is a depository account. Correct. And ease of shares locked with employer's custodian. Yes, you got some shares and then they have some lock-in period to hold, not to sell, but it will be under the control of the employer. So whether it is a depository account or a custodial account. Yes, it is a custodian account and yeah. So many are responding saying that it is a custodial account. Fine. And then the next one is ETF trading via online foreign broker. So somebody is doing ETF trading on an online foreign broker. Is it a depository account or a custodial account? So it's a depository account. And then shares held by trustee or nominee abroad. So somebody is holding shares on behalf of us in one foreign bank or foreign institution. It's a custodial account. So while filing or while submitting data for ITRs or while asking any client the information in case of foreign assets. So let us ask specifically what type of accounts they hold, any connection they hold in the other country. And then trading account with real-time access. It's a depository account. So we are done with few questions. So the next type of foreign assets which needs to be disclosed is foreign equity and debt interests held. So nowadays, many people are opening demat accounts, opening mutual fund accounts, or sometimes insurances also outside India. So basically, the equity and debt interest also needs to be disclosed in the income tax return under the Schedule FA if somebody is holding the foreign shares. And then ESOPs, in the case of ESOP, somebody got exercised and then the ESOPs are credited to their account. They have to disclose, especially if some client or some employee is working in MNC, they have to cross check whether really they have even one share, two shares also, we have to disclose in the income tax return. Then debt interest is foreign bonds and then loans and then debt funds. If they are holding any mutual fund debt funds, we need to disclose. The next category of foreign asset is the cash value insurance contract or annuity contract. So somebody purchased an insurance contract or annuity contract to invest outside India, like foreign whole life policies or overseas investment linked insurance policies, any foreign annuity or retirement plans with accumulated value, they have to disclose in the income tax return. The another category is foreign financial interest in any foreign entity, maybe partnership firms or any equity holding or any beneficial interest in any project or any joint venture or anything we need to disclose. And then immovable property. Immovable property, either commercial, residential, jointly, directly, or through nominee, we need to disclose these assets. So if we see the next category is the any other capital asset. So the above what we have covered is most holding assets, but here if you see any other capital assets, somebody might be holding a vehicle when they were working or when they were living in other country, they might be holding some vehicles, maybe luxury cars or any normal car also. If they are holding a asset and they came to India but not sold that asset, still they are holding, we need to disclose. Or even the gold, somebody visits recent times, many people are visiting Dubai or other countries, buying gold, sometimes keeping gold there itself with somebody or in their own custody. So those cases, it is difficult to track, but if it is being tracked through exchange of any other information by that other government to this Indian government, it comes under the definition of undisclosed foreign asset. And then artwork, and then intellectual properties. So these are the any other assets. And accounts in which you are signing authority, where somebody is a signing authority without any beneficial interest. Somebody might be operating a company. You have a signing authority, bank authority in the other country. Or when somebody having a specific account, companies here, but they have opened one small office where to open one branch office or kind of thing and opened a bank account to do specific project. And you, if somebody is a authorized signatory to that bank account, so those details also we need to disclose here. And then details of trust where we are authorized person, beneficiary, settler, and then trustee. So we need to disclose the details and then details of any other income derived from any source outside India, which is not included. So which are not covered under A to F, if still we hold some control out of India and we do not able to categorize under these A to F categories, still we need to disclose under this as under G, FAG. And if any income under the PGBP also we have to disclose here. So all these assets under Schedule FA needs to be disclosed as of 31st December. So for each type of asset, each line of item, there are specific disclosure requirements, something like account number, something like tax identification number, something like investment value, peak balance value, or even closing balance value. All those things we need to disclose in the income tax return. So yes, we are talking about foreign income, foreign asset. We need to disclose in the income tax return. Otherwise, Black Money Act will get affected and it will take its own course. So how to convert these foreign items to report in the income tax return? So if we take foreign income, first salary, the salary has to be converted using the SBI TT buying rate on the last day of the month, immediately preceding the month in which the salary is due. So in the case of salary, what happens is the income accrues to us or to anybody who is getting salary out of India every month. Because it is received on a monthly basis, the conversion also should happen on a monthly basis. Interest on securities, it is also similar where the interest is due the last day of the month, immediately preceding the month in which the interest is due, we have to convert the foreign income to Indian rupees. And then dividend, in which the dividend is declared, distributed, or paid, whichever is comes early, we have to convert at that date. And in the case of capital gains, in which month the capital asset is transferred, that is the key element here. And in the case of house property, PGBP, and any other uh, sources of income, it has to happen on a previous year, last day of the previous year, where we are going to file the income tax return. So at that date, we have to convert the incomes into INR while reporting in the income tax return. And in the case of foreign asset DTAA reporting, so we need same rate. So foreign assets, if we say we acquire at some certain point of time, but the value will be increasing, decreasing, and at the year end, it will be certain value. So how we need to convert these foreign asset values in the income tax return. So in foreign bank accounts, if we have certain foreign bank accounts, there will be some peak balance or where we have invested some on the date of investment, whatever is the investment or peak balance, we need to convert that into INR using SBI TT buying rate on peak balance date or investment date. And in the case of investments, we need to show both peak balance also and closing balance also. Throughout the year, throughout the calendar year, if there is any peak moment under which the asset value is hiked up, that balance we need to show and then convert that foreign currency into INR using the SBI by TT buying rate. And closing balance we need to show as of the 31st December 2000, whatever year. And then foreign property, uh, foreign investment. So foreign investment with we have to mention cost of acquisition, peak balance, and closing balance. So these dates will be different. Cost of acquisition will be different, peak balance will be different, and closing balance will be different. So we have to convert at the respective dates to show it in INR. And in the case of property, cost of acquisition, we need to convert into INR and then disclose. In the case of foreign tax credit, it will be converted on the last day of the month preceding the month of the payment or deduction of the foreign taxes. We see in the case of foreign countries, example US, the taxes will be filed generally in the month of April. The TDS might be happening on a monthly basis. So you need to calculate depending on the nature of income on the date of deduction or date of payment of the taxes. So credit, generally foreign tax credit is allowed Indian tax payable or foreign tax paid, whichever is lower. And then, so we have covered under normal heads of income, we need to disclose, and under FSI sheet, we need to disclose, schedule, we need to disclose, under TR sheet, we need to disclose, and under FA sheet, we need to disclose about foreign assets and income. Along with that, if the value of assets and liabilities could put together, either domestic assets or foreign assets put together, if it is more than 1 crore, even those details you need to consolidate and then disclose in assets and liability sheet also. Either it is immovable property, jewelry, car, vehicle, financial assets, cash, everything. So we might be holding a property in India, we might be holding a property outside India. So while showing in AL, we have to club both the line items and then disclose. And then liabilities also same case. If we have some loans in India, some loans in out of India, both put together, we need to disclose in this AL sheet. So AL sheet is similar to your gross as a globally as a person, how much you're holding as assets and how much you're holding as liabilities. So this is applicable only when the value of the total income exceeds 1 crore. So these are the typical type of assets: immovable property, balance, bank balance, cash in hand, loans taken in relation to the above assets. And then a recent mail communications and why FA compliance is under scanner. So why this is happening? So nature of recent communications received by the SSE. Many messages have been received in terms of mismatches or non-reporting of foreign income. So simply a message comes, your foreign income is not reported. Whether it is genuine or not, we don't know. And is it backed by any data also? We don't know at the time of receiving those messages. And non-filing and incomplete file filling of the Schedule FA. So majority of the cases, these Schedule FAs are not filled, even though person is holding foreign asset, but Schedule FA is not filled. How the department is able to capture? See, if somebody has filled FSI sheet and TR sheet, forgot to fill FA sheet, it is very easy for the system to run and then send a message. Or sometimes not TR sheet also filled, only FSI sheet filled somewhere. And information received from foreign jurisdiction. This happens. So India has many India has many agreements or many trade deals or many arrangements with other countries where it will receive information and it will share information. So in that perspective, any information received from foreign jurisdiction saying that so and so person holding so and so PAN is having these many accounts with us. So that itself is a data from out of India. The income tax department can circulate notices. So, so the recent communications are not just like that casual or generic or just to ignore. So there is a backed analysis, data, like authentic data, exchange of information between countries. So because of that, these recent notices have come. And requirement is to verify whether it is correct, incorrect is on the SSE. So these communications are data driven. It's not generic or random notices. So why foreign asset compliance is under scanner? So due to automatic exchange of information between the countries, common reporting standard with other countries, and do we have DTAs with other countries to avoid double taxation. In the respect of those agreements or DTAs also, there are certain articles where specifically other countries can share information with us and we can share information with them. So as of now, we have 100 plus countries where we have this type of arrangement and we are able to receive information from the other countries, which includes zero balance accounts and dormant accounts also. And the second category is where Schedule FA versus Schedule foreign data matching, where this happens. CRS data, the data received from other country and the Schedule FA filled by the assessees. So the income tax department has so much data. It got like so many crores of income tax returns got filled. In those data, it can simply pull out foreign asset schedules and then the respective PAN numbers it can cross check with the data received from other countries through CRS and AEOI. And then if there is a mismatch or if it is nothing is filled, sometimes there may be plus, minus, or sometimes nothing is filled. Simply it can alert the assessing so that he can rectify. But now with the awareness about this is not much. Recent time we have got messages. In future, we might not get such messages. Simply, we might get Black Money Act notices. So we have to be rest assured that we are disclosing proper details in the income tax returns. And then the analysis between the data are given in the same ITR. In the same ITR, we have FSI, TR, and FA schedules. The data is not synchronizing or inconsistency is there between these two data. That also can result in sending notices or communications. And then earlier, the pattern was to check scrutiny pattern was on the foreign income. Okay, whether underreporting income, misreporting income, concealment of income, all those things. Now the focus is on the existence of ownership. If some ownership is there, there should be definitely an income. If some ownership or asset details are being captured on a regular basis in income tax return, so the data can be built. The data can be built. Yeah, sir, we'll answer the questions. Just we are completing the slides. Just we cannot get all the chat questions, right? Yeah. So the focus is on the existence versus the income. So once the data is set right, like so many assets are being held by an assessee. If somebody is holding an assessee, it will generate an income. If somebody is generating an income, there will be a tax. Whether it is exempted, tax relief, deduction, those are all secondary. But whether it is coming to the tax lens or not, it depends on the source, any existence or any control over the item out of India or even within India. So that is the case. And once it is identified that you are holding certain item outside India, so Black Money Act, once it takes effect, there is a huge quantum of penalties, prosecutions, whether income is earned or not, or tax paid, whether tax paid in India or not, it will result into a non-compliance. So now, typical triggers for department mails, just let us have a quick recap. Somebody has foreign bank account opened during overseas employment and they might have returned to India but forgot to close the employment account. So in my recent practice, what I have observed is I have been doing some army people income tax returns where we do as a gesture, as a free this thing. So some army people got posted in London for 1 or 2 years to learn some technology on the whatever whatever professional services they need. They have opened account in UK. They got salaries in UK, and that person came back to India. When the department issued a notice, then he realized that he did not close the account. The amount is very small, one, two, three. The quantity is very small, but the disclosure is required. So if somebody is out of India, if they are coming back to India without closing the account, still those accounts are reportable. So it is precautionary if somebody is leaving that place and then migrating to India, settle all the accounts there. Or if you still wanted to hold those accounts and report, or if you don't want to report those accounts, settle all the accounts, close and then migrate to India. And then ESOPs or RSUs of foreign companies. So many MNCs, person will be working from India like Oracle. Best example is Oracle, Accenture, or any country where they work in India, but they might get ESOPs or RSUs of their head office, means the global company. And those accounts or those ESOPs will be credited into their foreign account. So it will be running condition. Unless you get into your Form 16, you will not realize that you got some asset, but that is also not reported. So, so that we need to take care. Foreign demat or brokerage accounts, and then overseas properties inherited or purchased. So their parents or grandparents might be in out of India and somebody is migrated to India. He got inherited property but not disclosing in income tax return. And then trusts or retirement accounts abroad. Somebody worked for 5 years, 10 years, and then they got so much amount accumulated in their 401k. If it is a US 401k, superannuation, any pension. But once they came back, they are not disclosing the details in India. And some cases, what I observed is some clients are very offensive also. Why I should disclose to whom? Why? On what basis you are asking? So a lot of questions will be there. We have to be patient enough to address their queries and then make them understand about the Black Money Act provisions and then obtain proper documentation and then report these items in the income tax return. What otherwise what happens is one fine day, one good morning, they will get a notice and then they will try to uh, highlight the accountant or consultant you have not advised properly. So instead of that, when we are at early stage, we'll try to educate them and then take the data and then file the returns. So and many people assumes when there is no income, why I should disclose? It is there, but I do not have any income. I'm not concealing any income. Why it would? It's not like that. No income is not disclosure at all. Even though no income, we need to disclose. These mails have to be taken seriously. They can lead to selection of scrutiny. They can lead to reopening of assessments. They can lead to Black Money Act proceedings, penalties, prosecutions, and then ignoring or casually replying can aggravate the risk. So now what steps to be undertaken immediately by either assessees or consultants or chartered accountants, whoever is working on the income tax returns. So it is not just for individuals, it is applicable for everyone. Either it is individual, firm, even companies where they hold certain foreign subsidiaries or where they hold certain foreign joint ventures, branch offices. So everything is matters. So what steps to be taken care by the assessees? In general, evaluate the residential status, whether you are a RO or RNO or NR, because it is a yearly activity. It is not just a permanent activity. So evaluate residential status, prepare a complete foreign asset inventory, whether it is small, big, any item. If you hold something out of India, just prepare the foreign asset inventory. Bank accounts, investments, immovable properties, trust, beneficial interest. And then cross-check statutory disclosures, whether we have filled those details correctly or not till now. Like FSI, TR, Form 67 filed or not, if we hold any foreign assets or incomes. And correct past non-disclosures. If there is a revised return timeline available, please file the revised returns. If not, if you find that there is a foreign income, if Black Money Act proceeds are going to be very serious, try to identify if any updated return can be filed and then get rid of, go and file updated return. And if even other timelines are also over, for the time being, you evaluate and next year at least you take care in disclosing the income tax returns. And then certain commonly missed foreign assets. So where certain high risk is there. So we are just trying to cover some polls here. So just some questions. Whether a dormant or a zero balance foreign bank account need to be disclosed. Everybody is saying yes, yes. Even if it is a dormant or a zero balance account, if we are holding any foreign bank account, yes, we need to report. Disclosure is mandatory even no income is earned on the account is inactive. Okay, are overseas salary account exempt after returning to India? Once we return to India, is it mandated to disclose? It is not required to disclose. Is there any exemption? Yes, no exemption, no exemption. So yes, you need to disclose unless we close. If you close the salary account and came back, no problem. Because once it is done, dusted. Otherwise, though, there is no exemption. And then is reporting only foreign income sufficient for brokerage accounts? Just we got some income and we are disclosing the income in the income tax return. Is it sufficient? No. So what else we need to disclose? we need to disclose the account details also. We need to disclose nature of account, the custodial or a depository name, account number. So all the particulars we need to disclose. Yes, nice. So account details must be disclosed separately even if income is already offered to tax. And do ESOPs or RSUs need to be disclosed if not sold or vested? It's a little tricky. Even if the shares are not sold, we need to disclose. But there is some tricky interpretation also here. If it is vested but not exercised, then there is no requirement to disclose. Reason because once it is vested, we have not yet exercised our option to get the shares. We do not have any asset. We just have a right. But unless that right has a transferability, tradability, marketability, we are not able to hold any control of it. So that's not covered here, but it's a point to be noted. If the ESOPs are vested and exercised, those needs to be disclosed. The next one is, are foreign mutual funds or ETF treated like Indian mutual funds? The foreign mutual funds or ETFs treated like a Indian mutual funds? No. 75% said no. Somebody saying yes also. No. Foreign ETFs and in foreign mutual funds are foreign assets and they have to be disclosed separately. That means they have to be treated as a foreign asset. They are not Indian mutual fund. They are not domestic. They are considered as foreign financial assets and must be disclosed accordingly. And then our foreign retirement accounts like 401k, IRR, superannuation reportable. These are retirement accounts. Yes. Yes, these are reportable because we have some control and we have some beneficial ownership on those accounts. Can small foreign deposits or bonds be ignored? Example, 1 rupee deposit or $1, £1, €1, €10, 10 pounds. No. So even a active account, even a 1 rupee, $1, £1, we need to disclose. But to effect under black money penalty prosecution up to 20 lakhs penalty prosecution may not be there, but tax effect will be there. So that we have to take care. So do assets held through nominees, family members or trust need reporting? Assets held through family, through nominees or trust. Yes, they're reportable. Only thing is we need to get into dialogue with the person to whom we are providing the service. If we ourselves filing the return, we need to have assessment of these things. Do we have any connections? Do we have uh, uh, any reportable items so that we'll not miss out these compliances? And are foreign insurance policies required to be disclosed? Yes, it is required to be disclosed. And then, is the change of residential status on the income tax portal is an automatic process? This is not related to the 9 questions what we have discussed, but I just put this question. What is our regular practice? Is the change of residential status on the income tax portal is an automatic process? Yeah. So somebody is saying no, somebody is saying yes. Everybody, majority are saying no. Yes. So why this is relevant? Why this is relevant is the residential status checking is majorly many times it's being ignored. And even if it is properly listed in the income tax form, we are missing to change the status in the portal. So please maintain whether the form, ITR form, as well as the income tax portal having the same residential status. Yes, the assessee must manually select and update the correct residency status while filing the income tax return. And then, yeah, so let's discuss some uh, nuances on the DTAA. So double taxation avoidance agreement. It's a bilateral treaty entered between two countries to avoid double taxation. To avoid double taxation and then allocate taxing rights, provide tax relief, then promote cross-border transaction, trade and investment, prevent tax evasion, and avoid uncertainty and predictability in the taxation. So how FTC is claimed? Just wanted to ensure. So in the case of FTC, that is being calculated through certain process. So just trying to capture some steps. So include your foreign income in the total income and then disclose details in the schedule FSI and then compute Indian tax on the gross income, including foreign income. Compute Indian tax with foreign tax. Compare the Indian tax on foreign tax. So whatever foreign income is there, first we are including in the gross total income and then calculating taxes on it and then identifying the average rate of tax and then foreign tax average rate of tax. We'll compare both. According to that foreign income, we'll apply that average rate of tax and then claim the foreign tax credit, whichever is lower in Indian perspective or a foreign perspective. And then while claiming that FTC, you have to fill mandatorily this TR sheet as well as file this Form 67. So unless the Form 16.7 is not filed, the CPC is processing with a demand. So make sure that if you are claiming some FTC, Form 67 is to be filed and the calculations also to be properly done as per the Rule 120 of Income Tax Act. And some practical example on the this whatever FTC related. So there is a resident, Mr. A is a resident, an ordinary resident in India. He got these incomes, salary from Indian company, and then US shares related dividend is there, and then rent from US property is there. So how generally the flow happens? Step one is as he is an ROR, global income should be taxable in India. US taxes income due to source rule. And then DTA comes into play. Whatever US is taxing, USA deducts tax as per the DTA limits, and then salary from Indian company taxable only in India. Reason because he's a resident in India, and then global income is taxable in his case. Whatever is tax deducted outside India, he has to consolidate and then calculate the FTC. So Mr. A can claim FTC, and that FTC, while along with Form 67, he has to do the process. So what are the steps? So he has to fill foreign asset disclosure, whatever he is holding there, because he's holding some property there, and he's getting some share dividend because he's holding some shares there. And then fill the schedule FSI and TR with foreign income and tax paid and tax relief, and then claim FTC using Form 67. So India, USA, DTA helps in avoiding double taxation with one country is being taxing uh, the other income and then giving some relief to avoid the double taxation. And this is another example where a person of UK resident but having income from India. Salary from UK employment is this much and capital gains on UK shares is this much and rent from Indian property, credit for the Indian income tax. So this typically goes like as he is an NRI, he is liable only for the income originated or accrued in India. He need not disclose anything in Indian income tax return about UK incomes or assets. So taxable, the UK salary is taxable only in UK and UK shares capital gains are only taxable in UK. Indian property rental income is only taxable in India. So he has to claim foreign tax credit in UK against the taxes deducted in India. So compliance requirements will be he has to file ITR as NRA, declare Indian rental income, And then TDS, if anything is there, we have to claim as a TDS credit. Maintain Form 16s, and then no disclosure of UK salary or UK capital gain in Indian ITR. So these are the two examples. So now we have certain more queries, some FAQs on the disclosure, tax impact, and then DTA relief part. So let us run through these questions. Whether foreign bank account is holding, no interest is earned. So whether FA disclosure is required, yes. Whether tax impact, because there is no interest, no tax impact. Because there is no tax impact, there is no DTA relief. It is not applicable. And then foreign bank account, interest is earned. Because we hold foreign bank account, we need to disclose that. Tax impact will be there. DTA relief we can claim. So we are getting, I think, some polls also. If comfortable, please submit this and attend these polls. And the next point is foreign shares held but not sold. Yes, FA disclosure is required. Tax impact should not be there because there is no sale. And then DTA relief is not applicable. Foreign shares sold, capital gain is there. If still some shares are there, yes, FA disclosure is there. Tax impact also will be there. And then DTA relief also we can claim. The ESOPs vested but not exercised. Vested but not exercised. In this case, we do not hold any asset because we do not have any right over the asset. We just have a right to future acquiring asset. In the case of ESOPs, vested but not exercised. And then tax impact nil, and then DTA is not applicable. So foreign ESOPs exercised and shares not sold. Yes, FA disclosure is required. Tax impact will be there. This is again a peculiar issue. When ESOPs are exercised, shares are not sold, still tax impact will be there. The reason because once the shares are exercised, there will be a portion from our own salary will be deducted towards our contribution towards the shares, and that contribution is one way where it is an additional salary given by the company to the employee to acquire these shares. So that is a perquisite. If that is a perquisite, yes, there will be a tax impact. If there is a tax impact, yes, we can claim the DTA relief. And again, gold purchased and held abroad. Yes, it is a foreign asset. Disclosure will be there. And then tax impact nil, and then tax relief not applicable. If the gold is sold, FA disclosure, if still any asset is there, yes, we need to disclose. And then tax impact will be there, and then DTA benefit also we can claim. So these are certain FAQs on this. And then, yeah, so we came to the last part of the presentation where the recent budget, the finance minister has put some proposals on like to make sure that everybody get awareness of these provisions. And they proposed a new scheme called Foreign Assets of Small Taxpayers Disclosure Scheme. So we have discussed about Black Money Act, where it says if any foreign asset is there, somebody is not disclosing, the Black Money Act can take effect. If Black Money Act takes effect, any assessment notice comes, then 30% tax, three times of the tax will be penalty, and then 10 lakhs penalty, and then 10 lakhs penalty. That is going to be huge burden, or that is going to be a very serious concern to anybody. To limit limit that effect, the serious effect, they proposed a new scheme called Small Taxpayer Disclosure Scheme, where they introduced two categories of approaches. Where I'll just go to that next part, to encourage voluntary compliance and provide a resolution framework. So this is going to be a voluntary declaration. Somebody has to come on their own and declare whatever assets they have, whatever incomes they have. So this is similar to our DTVSV. In DTVSV, direct tax Vivas Vishwas scheme, if there is any litigation which is in progress and somebody wanted, I don't want any further proceedings on this, they can pay the tax and then the department waives the interest and penalties. If only penalty is there, like some 25% penalty, if you pay, your case will be closed. Something like a amnesty scheme in GST and then DTVSU scheme in income tax. For Black Money effect also, they are proposing this scheme to small taxpayers. And the immunity will be there in the case of penalty and prosecution in this scheme. So the core principles for this scheme are, there is a category A where individual who do not disclose their overseas income and foreign assets, which means somebody is holding foreign asset and income or only foreign asset, but they have not been disclosing at all. They are not filing. They are not, even though they are filing, they are not at all disclosing it. And the aggregate value of undisclosed foreign income and undisclosed foreign asset does not exceed 1 crore. If it is does not exceed 1 crore, the computation is given below. 30% of the fair market value of undisclosed foreign asset, 30% of the fair market for 30% of the undisclosed income, and an equal amount to 100%. Example, income and assets put together, it is not crossing 1 crore. And exactly assume it is 1 crore, 30% on 1 crore, which is including asset and income, 30 lakhs plus 100% of the tax amount means 30 lakhs. So 60 lakhs if you pay, you will not be levied with penalty of additional 2 times. You will not be levied penalty of non-disclosure, non-filing, and then you will not be prosecuted under the Black Money Act. No imprisonment, nothing. So only penalty is 30% tax and equal amount of the tax means 100% of the tax as a payment, as an additional payment. There is another category where asset was acquired while he was a non-resident out of income earned outside India, which was not disclosed in the fixed foreign asset. After he became resident, say somebody was working in US for 10 years. He worked with some company, example called Uber, and then he came back to India. And then see, once you come back to India, it immediately will not become ROR. You will take some time to become ROR because that last 10 years ka minimum 7 years, minimum 2 times resident, and then 730 days or more. So to reach those conditions, it will at least take 1 or 2 years. But after returning to India and then becoming a resident, somebody is not disclosing still the foreign assets and asset acquired from income already offered to tax in India, but the asset was not disclosed in FA. So in these two instances, income is being disclosed, but assets are not being disclosed. Means income tax is being paid, but in these two scenarios, they are not disclosing only the FA part. And the foreign fair market value of the foreign assets is only up to 5 crores. Then there is an immunity from the department. If you pay 1 lakh fees and then disclose in the declaration, then there will not be any penalty and prosecution on the assessee. So under these two categories, they are going to come up with the new scheme. The notification, the detailed notification along with the rules forms is yet to come. Once it is released, somebody wanted to disclose, they can disclose by filing certain declarations. So yeah, filing a declaration in a prescribed form, the details of the asset, maybe particulars of the assessee, and then once the declaration is filed, the authority will verify that and then pass an order to pay the amount according to these categories, whether you are falling under category A, category B, according to that, they will try to calculate the amount and then pass an order. And then the assessee has to make the payment along with, against that order. If within 2 months from the end of the month in which you receive the order. And then once the amount is paid, we have to intimate to the department. And then once we intimated, we get a certificate from the department saying that, yes, we considered your declaration and we received your amount, and there will not be any further penalty or prosecution on this matter. That is a declaration process. And yeah, certain key case study we are putting. And Mr. A is a resident, ordinary resident in India. He holds undisclosed foreign assets aggregating to 1 crore. And then foreign immovable property is 50 lakhs. And then bank accounts and shares are 50 lakhs. So he, because the total amount is up to 1 crore, he is eligible to file a declaration under this scheme. And then these assets were not reported in FA of his income tax return. Yes, it is not reported. So case one, undisclosed foreign income. He did not disclose. The assets were acquired out of foreign income earned abroad, which was never disclosed or offered to tax in India. Case two, disclosure lapse. Only the income part is disclosed. Assets were not disclosed. Why? Like how we disclosed in the category B of the scheme. However, after becoming resident, he failed to disclose these assets in India. So for these two cases, so how the approach is going to be. So if you get into the nature of default under Black Money Act, under FA STD category A, under FA STD category B, the prosecution, the procedure is going to be like this. Undisclosed foreign income or assets under Black Money Act. And then tax will be, yes, if it is 1 crore, 30% tax, it is 30 lakhs because 30 percentage. And then penalty will be 90 lakhs plus 10 lakhs for inaccurate particulars or non-filing of return at all. That is a straight away penalty, means under a blanket penalty, I would say. And then additional amount will not be there because additional amount concept is a FASTD scheme. So prosecution, yes, applicable, I think 6 months, 7 years, whatever category. So total outflow, if anybody is affected, 1 crore asset or income you have, but you will be levied with an amount of 130 lakhs. That much serious it is. And if you are within this 1 crore limit, if the notification comes immediately, if somebody is filing a declaration, this is the method of calculation. Yes, 30 lakhs we need to pay. There will not be any penalty. Additional 100% of the amount, that is another 30 lakhs. Immunity is available under prosecution. So there is no prosecution. So the net effect is 60 lakhs if you pay. You will not be prosecuted under the Black Money Act and there will not be any penalty. And then, yes, disclosure is there. Only income disclosure is there. Income already taxed in India. Income disclosure is there. Income already taxed in India. Only FA is not disclosed. In that case, no tax, no penalty. Additional amount will be only 1 lakh fixed fees. And then immunity is available under that act. So we need to evaluate under which category we are falling into, or into which category we have some clients to advise them, and then just see through the notification and then apply this declaration by educating the people. Yes, the key takeaways, just summary where schedule FA, AL, TR, and FSA relevant to ITR schedules, yes, must align. It should be synchronized in a proper manner. And then non-disclosure may trigger BME implications even if income is exempt. We need to disclose. Disclosure is as important as taxability. And then increased regulatory scrutiny because of exchange of information from other countries. And then foreign reporting is no longer voluntary or just ignorance of law is also not applicable, not acceptable. So let us see the correct classification, timely filing, and then proactive approach in getting the data from the clients. And then while issuing, while calculating also be sure that go based on some proper documentation so that we will avoid any miscommunication or a communication, any issues with the clients. So that is the end of this presentations. So I think we have some questions. So let me just go through those.
Thank you, Yashodhan sir, for the insightful and practical presentation. We will now open the floor for the Q&A session. I request participants to please post their questions in the chat box. Actually, there is a question from Faizuddin Syed. My spouse does not work and has got no sources of income in India while I am employed and file my IT returns. Since my spouse has no source of income, if I buy the asset in my spouse name, do we have to declare the asset in India?
Disclosure of assets and things in India applicable only when annual income is more than 1 crore. If your income is more than 1 crore and then you hold any assets, that we need to disclose. The second thing is, if we buy an asset on our spouse name, again we have to look at the clubbing provisions, whether we are transferring any income on their name. If we are transferring any income on their name, we need to club that income in our tax return and then take certain exemptions, pay the taxes. So buying asset on other name, if the clubbing provisions are complied, so there is no unless the 1 crore income category, if you are not coming, there is no requirement to declare the asset in India. Any other questions?
Yes, sir. There is another question asking that self-assessment tax paid on rental income in India will be allowed as tax credit in foreign country while filing return in foreign country.
Yes. See, if you are a resident out of India, means if you are resident in US or UK and then you paid taxes in India because of some property in India, you are getting rents. And then this rental property income, you are again consolidating in US as a global income. Then whatever taxes we paid in India, we can claim a tax credit in the other country.
Uh, Another question from Mr. Jagadish. Interest is taken last day of previous month TT rate, but in Indian currency received excess. How to treat that excess amount in income tax?
Can you please repeat the question?
Interest is taken last day of previous month TT rate, but in
Yes.
Indian currency received excess. How to treat that excess amount in income tax?
See, excess amount, see, once we are getting a rent or interest in any month, last day of the previous month, we are going to take the TT buying rate. So whether you are receiving exact amount, excess amount, we are going with the previous month closing date. So according to that, we will apply that exchange rate and then calculate the taxes. How income tax department know someone is a resident from other countries? No entries in Form 26 areas. Sir, as of now, it is purely based on data provided by other countries. Along with that, the information we are filling in the income tax form, inconsistencies between the schedules, and the bank, sometimes any other case, you got some information given to some banks or anything, some interconnection with other countries. Through that, income tax department might come to know. So that if we know that CRS, common reporting standard, many countries are having that interrelation, get the information. Bank transactions and then exchange of information, and then if we if we are a party to any foreign transaction with other company, there also our names will be there. Sometimes a joint venture or a branch is opened, our name, we are working as a some senior manager in a project, our name might be there. So like that, they'll be able to know. And then employee resident in India holding ESOPs of Nasdaq listed shares. Is it ESOP or just okay ESOPs? He sold shares in USA and transferred to Dubai for purchasing house in Dubai. So we need to report the same in Indian ITR. So if he is a resident, as per income tax provisions, if he is a resident and ordinary resident, then yes, definitely we have to disclose these shares as well as the property. But again, selling of shares and then buying of the property in the same year, we have to disclose both. In the next year, in the see 1 year we sold shares and then next year we purchased property. 1 year we need to disclose shares, and the next year we need to disclose the property. And then a person stayed in USA for 9 years and came back to India in May 2025 is having PF account balance in USA in the investments in shares there. Any disclosure compliance in ITR. Sir, if he's came to India in May 2025, maybe we have to wait for 1 or 2 years depending on his past stay records in the country, in India. See, even though he was staying in US, he was traveling between US, India, US, India. We have to count to the number of days. So once he is there in India on May, definitely 182-day condition is uh, met for 25-26 financial year. But to get RO or RNOR, we need to get back to the last 10 years transaction, I mean, travel history, and then decide. If he becomes ROR for 25-26 itself, yes, we need to disclose. Or if he's just RNOR for 25-26, 1 year, we can have an exemption. Next year, we need to disclose. PF account, yes, we need to disclose. In the financial year 24-25, if the assessee holds few shares in traded outside and if such income is not reported, if he is a resident. So what is this question? Few shares in traded outside and if such income is not reported. Sir, we need to disclose both income and shares also. The question I understand is you traded some shares, you got some income, we need to disclose. If you are holding any closing balance of the shares, that also we need to disclose.
If anyone have any queries and wants to ask questions directly, I think there is another question posted, sir.
The non-disclosure of information related to foreign assets in my income tax return. How income tax department know regarding that foreign assets? Sir, it is through that exchange of information by other country. A US country, example, they will share the data with Indian government. That Indian government through Ministry of External Affairs will exchange the information with the CBDT, that is Income Tax Department. So that Income Tax Department will scrutinize the data and then issue notices if they miss any foreign asset reporting. And Ms. Joshna B. Foreign investment, cost of acquisition, peak balance, closing balance. Thus, the cost of acquisition means the opening balance only or acquisition during the calendar year also will be added. So, ma'am, investment, we are talking about cost of acquisition, no? Investment value along with opening balance, we need to add current year acquisition also. Because we have to maintain the track of total cost of acquisition of those shares. Yeah, so yeah, any other questions?
If anyone wants to ask questions directly, you can raise your hand. We can unmute them so that you can ask the questions directly.
So, Shashikant, is RNOR required to disclose foreign bank account in Indian ITR? No, not required, sir. RNOR is not required to disclose foreign bank account in Indian ITR. Peak balance is also same rules applied to convert. Yes, same rules. It is see actually in the case of peak balance, it's a peak balance is happening in two three places. One is the bank statement, the other one is the custodial account, depository account, some foreign interest also. We have to disclose cost of acquisition and peak balance and closing balance. So cost of acquisition, we will convert at the TT buying rate of the month in which it is acquired. Peak balance, we will convert at the rate where that peak balance happened. And then closing balance on the date of 31st December, because in FA sheet, we have to report the values at 31st December. So conversion rates will be according to the dates we need to select. Request the presentation. Yes, sir, we can share the presentation. Yes, I'll share with HCAS team so that they can circulate. Can we download PPT? So it will be shared with the HCAS team so that they will maybe upload in the WhatsApp group, or you can download. Any penalties under FEMA will come into picture because of non-compliances under this. So FEMA related, so we have not covered here, but FEMA related disclosure returns as such is not there. But if we do any something called send inward remittance, outward remittance through the banking channel, then the FEMA non-compliances may come. In the given case, unless you cross those limits, you will not come into the lens of FEMA. Normally, if we take LRS, any person can send up to $250,000 only out of India in 1 year. Till that amount, just banker will ask one certificate. Other than that, no prior approvals of the RBI or anything. But once it reaches a certain level, you need a specific permission from RBI, then we will be under the lens of FEMA. So as of non-disclosure, disclosure related FEMA, I don't think so there will be anything. And Mr. Power is asking if if a person is a non-resident director, okay, non-resident director in foreign company, and the same person becoming the director in Indian company as a resident. In so many companies, the directors are acting like that. In this case, how they should act regarding that? Sir, first of all, non-resident director, resident director, like their terms are not there. So first thing is whether he's a resident or not. Whether he's a director in foreign company, director in Indian company, we need to go by the residential status of his stay in India. If he stays more than 182 days and then uh, last 7 8 years, if he stays more than 730 and he was a resident in last 7 years more than 2 times, last 10 years more than 2 times, he becomes a resident. Once he becomes a resident, you are saying he's a he's a director in foreign company. For example, he is holding an authority to sign any document relating to bank accounts in foreign company. Yes, he has to disclose the details in FA schedule. Okay, so can we take RBI reference rate for exchange rate? So as per Income Tax Act, it is only given SBI TT buying rate only, not RBI rate. So that is specifically given under Rule 115, and for calculating foreign tax credit under Rule 128, subsection 5 is there. So specifically rules are there. We have to go by the rules. And then Mr. Shivakumar is asking peak balance to be computed each share wise if they have owned and sold multiple scripts. So each share wise, yes, we need to calculate each share wise and then sum it up and then disclose. Actually, we should disclose each share wise details only in the income that form. Can we report consolidated value of closing balance of sir? So there it is specifically mentioned the type of asset and all. So it is better. See, if there is so many data, so we can consolidate, but for calculation purpose, it has to be done each share wise and then consolidate and report. But if there is any additional requirement from the department, that time we need to attach the detailed workings. So we need to consider the capital gains for the sale of part of SOPs by companies for payment of tax in foreign. Yes, I think this happens. I think Mr. Kedarnath is asking, do we need to consider the capital gains for the sale of part of the ESOPs? Yes, this happens. Like example, somebody is getting some ESOPs. To buy the ESOPs, to buy the shares through this ESOP scheme, they have to pay perquisite tax because the company contributes some amount as a perquisite. To get that perquisite tax paid, most of the cases employees do not fund that money. So what the company does, it will sell certain shares, realize the money, pay the perquisite tax, and allocate the shares to the employee. Yes, that transaction comes under the definition of capital asset sold, and capital gain will come. We have to disclose that in the income tax form. So that's for your timely response. Okay, Shiva Kumar, thank you. So Mr. Joshna, Obtaining peak balance is very tough, sir. So what is the purpose of peak balance disclosure in reality? See, in reality, just to see if somebody is manipulating on the uh, capital gains or taxation point of view, they wanted to track the peak balances. Sometimes what happens, you might buy some shares at $100, that value of share might go up to 500, $600. Suddenly we are showing less income or less closing balance. We are misleading some information. To avoid that, the peak balance or the opening balance, I mean, the cost of acquisition and closing balance, to maintain the consistency, they are asking the peak balance. So as per my understanding, that is the requirement. In my opinion, that is a requirement. And Mr. Muskan Sethia, what is the limit of inward remittance if an NRI wants to transfer funds to a resident? Is there a limit of complaints? Sir, FEMA related, I need to recheck, sir. I don't think so. There is a any such requirement, but there are certain restrictions on the investment or anything like that. So you cannot buy agriculture property, something like that. Is there? And thank you, HCS committee, HCS management committee for giving me this opportunity to share my thoughts on this topic. And yeah, my details will be available with them. If anybody wanted any clarity or further explanation, yeah, definitely we will be able to support and provide our services. Mr. Kedarnath is asking in which category we need to disclose the foreign assets, foreign shares under FA schedule. See, equity and debt interest part is there under that category. We need to disclose. Yeah, I will share circulate this PPT with HCS team. They will be able to share it. So thank you very much.
Thank you once again, sir, for sharing your valuable knowledge and experience. And I sincerely thank all participants for joining us today and for your active engagement. Have a good evening. Thank you.